Hello and welcome. So today we're going to go through, as part of the personal finance kind of masterclass that I'm doing, to go through everything investment related. So things that we're going to cover off in this session is here. So basically covering off why to invest in the first place, future goals and a few other things, and the purchasing power that money has. What your investments, what are investments in the entirety? So understanding a little bit more about what do they do, how do they work, when to invest, whether that's starting now or a little bit later on, and how that might look. How to invest as far as the time horizon, actually selecting the platforms, the investments, and what you need to actually start to consider before you make the sort of jump into the world of investing. And then the last one is going to be tools you can use, things that are like tax wrappers or directly investing in certain assets like property, and a few other things that I'll cover off as we work through. So, firstly, why to invest in the first place? So, it's some things might be more obvious, and some other things less so. So, firstly, it's the future, that you want. Taking the steps towards building a prosperous future is key to sort of living comfortable, essentially. You want to make sure that you're not just sort of scraping by. If you've got sort of goals and ambitions that you want to achieve, and I always say to people, especially the clients that I speak to, you work very hard for the money that you earn. So why not make that money work even harder and essentially give your money a job? So you employ your money to do a job, and that is investing. So you can try and earn money on the money that you've put in those sort of blood, sweat, and tears to go in, to make sure that that's actually you're reaping the rewards off the back of that. So a goal to aim for, this can be various different forms, but having a goal kind of can, for some people, not for everybody, but for some people, can really help set an intention of what you want to actually look to do. So if you're investing for a particular thing, it could be a once in a lifetime cruise. It could be I want to invest or want to actually invest towards purchasing a one-off type thing, such as like a boat or a yacht. Could be something as extravagant as that. It could be because you're a first-time buyer and you want to save up towards a deposit, and kind of anything in between. Really, it can be for many different things, even later care costs, all different things you could actually choose to invest. Or if you just decide that you don't want to let your property sort of erode away, not your property, sorry, your funds and your savings erode away, then capital preservation as well is quite a common one when I'm chatting to clients as well. So yeah, a goal is to make more. If the goal is to make more money, and that's only the goal, then there's nothing wrong with that. And if you've got the goal to plan to spend it, there's also nothing wrong with that as well. It's your money. It's just making sure that you've got the correct plan and the sort of investment strategy to get you there. And also, I always think it provides you and your family with confidence. If you know that you've got the right funds in place and you know that you've got some savings and you structure things, and I'll talk a little bit how to do this in a moment. If you've got the right things in place, it does give you more confidence in moving forward. It gives you kind of good foundations. It means that you're not just sort of easily frittering money away, which is so easy to do in today's world of, you know, transacting with a credit card as opposed to paying with cash. There's a bit of a psychological thing there. With cash, you actually give away and you get the product in return. Whereas your card, you tap and you get the card back. So psychologically, you don't feel like you're spending as much than if you had some money in your actual hand and you gave that away. It kind of cuts a bit deeper, let's say. So it kind of gives you a bit more confidence if you've got savings and investments to actually make sure that you've got things there and you've got a plan and a kind of vision of where you're wanting things to go. So now the sort of more logical bit. So that's kind of the emotional bit that I like to sort of talk to clients about, because it is finance is an emotional subject for a lot of people. Whether if they're in from situations where they're struggling because they're in debt, all the way to they've inherited some money and they don't know what to do with it because it's got an emotional tie. All of these things do factor in, very important when it comes to sort of general investment planning and what you look to do with that money. Now, the more kind of logical part of why you would particularly look to invest is, you may have heard of a thing called inflation. It's something that's been sort of floating around as of late, and I always call it the silent assassin of what it does to your money. So it essentially erodes the purchasing power of your funds, and this can have quite a drastic impact. And I'll show you some examples in a moment of how that looks, or right now, I should say. So this is quite a simple one to kind of wrap your head around. So here's an example. If something costs £10 and it goes up by 2%, then the cost would be £10.20, and that's an increase of 20p. If the amount is of a bigger size, even though it's a percentage change, the actual change due to it being a percentage is kind of relative to the size of the thing that you're purchasing. So if it was something that was £1,000 and it goes up 2%, then it costs £20 more. So inflation has this effect on money where, because essentially, without going into all the nitty gritty and the economics of it, is that the government are continually essentially printing money. And because there's always a supply of money, the goods and services ideally need to be about 2%, is where the government want inflation to sort of sit at. They don't want it to be zero, because then you're kind of in a stagnant environment. They want it to be where it's 2%, and then that 2% means that there's a flowing economy. Essentially, people are buying things, not out of control where things are really expensive and people are struggling. 2% is where they want to kind of keep that as a nice steady growth long term. So that kind of gives you one example. Another example is if sort of a bottle of milk and you had £1, and then if it was a 10% rise, it'd be £1.10, and then 10% on that original amount, which was the bottle in 2024, is just an example. It would then go up again another 10%, so £1.21. It's just an example to give you a bit of an idea on how inflation works. So when people say, oh, things are getting more expensive. Yes, some things generally do get more expensive, fuel and all sorts. Now, there's other things that do just go up because it's inflation that's making that happen. So because things are naturally just going to keep getting more expensive as time goes on, or not more expensive, but relative to what the amount of money that's being printed and that's in circulation, things appear to be more expensive. It's important that your money and your funds and your savings are at least doing the same to keep up with it, so that then you're not left by the wayside. An example would be if you had a briefcase full of money and you chucked it under a bed and didn't do anything, and then opened it in 10 years to use that money, you're not going to be able to buy the same amount of goods and services. So that's kind of a bit of a logical part as to why would you even invest in the first place? Because some people are like, oh, it's risky, you could lose some. Yes, you could, but the thing is, you're always guaranteed to lose money if you don't do anything with it. So you kind of have to choose which one. And if you plan it right and you structure it to your attitude to risk, it should be a journey that's not giving you sleepless nights. So you want to make sure that you're in a comfortable position, you understand the investments and what they're actually going to do. So that's the a little bit more around sort of the actual product side of things. Now, what is this inflation thing? Like, what does it even do? Well, let me just get rid of that icon there so you can see what we're looking at. So as this is just a graph just to kind of show you, don't worry about understanding it, but ultimately it's the consumer price index, which is the way in which they track inflation, which is one measure. That's kind of your core inflation, as essentially it's called. Then you've got your consumer price index, or CPIH, which essentially is including housing costs. And then you've also got housing costs or owner-occupier housing costs in isolation. And those three are obviously plotted on there to kind of see how that essentially works over time. And then this one obviously will give you a bit of an idea on where inflation's gone in more recent terms. But ultimately, it just gives you a indication that there is actually a few different ways that they measure inflation, because it's not so simple as just going, well, it's this. Because there's housing costs, there's, which are taken into account in the full overall CPIH, which is kind of everything. But if you're just looking at CPI or the consumer price index on its own, it doesn't take certain things into account. And you might think, well, how does all of this even get calculated? How do they even figure out what the CPI is? Well, it's quite a basic way that they do it. They essentially get a basket of goods and services, and they do this regularly, where they'll buy those goods and services, put it into a basket, and see what the value of those same goods and services was compared to the last time they did it, which can be quite frequent if they're trying to monitor it quite often. And then they go, well, did that pack of eggs, or did that pint of milk, or even did that like TV? There's all sorts of things that are in this virtual basket that they essentially assess and go, has things got more expensive, or where is inflation running? So if inflation's speeding up and they're going, well, last time the pint of milk was only worth this much, and now it's gone up significantly more over the percentage way higher than we want to keep it, which is at 2%, then that's where the government start thinking, well, we need to start pulling certain levers to try and slow things down so it doesn't get out of control. And that's why people say, well, can't they just print more money? Well, if you print more money, you create a supply of money, which then means inflation will sort of run out of control, which means then you could, and it's happened in other countries in the past, where inflation's gone so high that you end up paying what seems like ridiculous amounts of money just for a loaf of bread. So imagine having £100 and, 100, even thousands of pounds that you're having to pay just for a loaf of bread, compared to like, £1.50, £2, depending on what your bread is. That makes quite a bit of a difference. So, and that's where you might have heard of things called devaluing the pound, and in sort of past times they've had to do or look to do, which they don't want to do, because it then against other currencies it starts to have a knock-on effect as well. So it plays a massive part in everything, and kind of having a little bit of an understanding of why inflation does what it does and how it works means then you can start to wrap your head around what's the importance of investing in the first place, rather than just leaving it in a bank in cash, because of the long-term effects that can have. Not to say that you shouldn't have any in cash, or you shouldn't have any short-term savings, because you should. And again, we'll cover that off in a moment. But sort of long-term wise, if you're looking to build wealth over at least a 5-year period, then yes, you need to be looking to invest, so that then you're not kind of exposed to this silent assassin that is inflation. So sort of the main takeaways from it is it erodes your money. Now, the thing that I haven't touched on is it can actually work for you if you have debt. And this is why when you have a property and you've got a mortgage, if you have a large mortgage debt, inflation can work for you as well, in the sense that it can reduce the overall debt quicker than it would in normal times, which is why if you bought a house and then 5-10 years later you go to sell it, well, firstly, you'd like to think that the property's appreciated in value, which is great if it has. And then on the flip side of that, also the debt, let's just say it was £200,000 you had as a mortgage debt, over time, that £200,000 is not going to be the same value as it was in sort of 10 years ago, because inflation has eroded its purchasing power. And in that sense, it's actually worked for you. So in some instances, if you've got lots of debt, inflation can work for you, as long as, you're not factoring in interest rates and cost and all of those other things, and the stress that it provides to you if you do have lots of debt. But for mortgages and things, yes, it can erode the actual debt. But if you've got savings, then it can also reduce the purchasing power of that money, so it can work both ways. So I hope that makes sense. And a good example of this is I've actually got a very good client. When I was explaining what inflation was and how it all worked, and he said to me, he received some money quite a few years back from a motorcycle accident, and left the savings that he had untouched in a savings account. And I was like, oh, okay, that's, how long? And in this case, I think it was 10 or 11 years. And I think it was about 9,000-ish or somewhere around there. And ultimately, when I was explaining it to him, the first thing he says, I didn't know his situation at this point. I was just explaining, like I am now, how things work, and just to give people enough information to make a decision to see if investing and things are right for them, and if I was the right advisor for them as well. And then he literally stopped me and says, "Pete, I know exactly what you're on about." I was like, "Oh, right, okay." And then he proceeded to explain to me that he's had this money, and if he was to have done something with it then, he says back then, he could have even used it to put, I think it was a bit longer than 9 years ago, actually, because he was talking about houses. So he could have looked to use it as a deposit on a house, whereas now it would get you an okay second-hand car for the amount that he's got. So he was kind of saying it does play a massive impact on what the actual costs of that you can buy with, and the effects that inflation have. So seeing it sort of personally, and when I spoke to clients and how it can affect them, and then also obviously when you look back at data and charts and all that wonderful stuff that I do, you will you kind of get to actually see firsthand how that has a knock-on effect to money as well. Especially when you look to sort of back test money, something that we do and I do as an advisor, is you go, well, what was that amount of money that you've got now? What would it have been worth if you invested it, sort of 10 years ago? It could be worth this. And that helps us kind of give a rough idea of what types of investments that client would be comfortable with. The future's never a predictor. The past is never a sort of predictor of the future, but it's just something we've got there as a tool to help us in our decision making. But you can do that with inflation. If you was to have done something with this money, I don't particularly like to do it because it's hindsight's a wonderful thing, but it can give you an idea of what that money would have been worth if it was invested and it didn't have the effect of inflation on top of that as well. So now we've got what are investments. So what is this thing that is investments, which come in all different forms. I've broken down sort of the main asset classes really. Some more very, very complicated ones I've kind of left off, but the main bulk ones are here. So we've got equities, and I'll explain what equities are in a moment. They're essentially shares in a company, actually, just to kind of nip it in the bud there. But they are shares in a company, and you can have these in the UK, North America, Europe, Japan, emerging markets, Asia. There is literally like all over the world, global companies all over the world that you can choose to own a percentage of, which would essentially mean that you have an equity stake in that business, which would be in the form of a share. Then you've got bonds, and bonds are essentially loans to companies. And again, I'll touch on this a bit more in a moment, but you've got government bonds, which are essentially loaning money to the government, and they're in the form of what's known as gilts. You've got inflation-linked bonds, corporate bonds to bigger corporate organizations that are looking to raise finance, and then high yield bonds. You've got property, both directly held property funds, so physical buildings, and then you've got indirect property funds, so shares. So that would be a company, like a limited company that has lots of properties, and you would essentially own shares of that company, that the underlying asset is in property, as opposed to holding them yourself. Then you've got alternatives, so commodities. Then you've got infrastructure and private equity. I'm not going to go massively detailed because for probably most people watching, that's probably a little bit more complicated. And if you were looking at something like that, it's definitely more of an advice area. And then the most simple one really is cash. You can have this in instant access savings or sort of fixed rate deposits. So just your 2-year fixed saver, 5-year fixed saver, however long, that where you tie that money up and then you get a percentage interest rate on that. And then you can then essentially, after that period of time, access that money. Funny thing is, with fixed savings, you get a guaranteed income from them, from the bank. But the way in which the bank actually can generate and pay you an interest is because they're actually investing your money for you instead of you doing it directly. So fixed savings just means that the bank go, thank you, we'll pay you a small interest because you've put this money in our deposit account. We're then going to use that deposit account money to then invest for their own purposes. So when I always say to people they're not really investing, I'm saying, well, you're kind of investing indirectly as opposed to you having to do it. So you are getting a fixed interest, and there is certain securities and things that are given by investing in a bank. You get the financial services compensation scheme and a few other things, and the risk of losing your money is a lot lower than it would be for investing, but they are still investing your money, and you've got to have trust that that bank is not going to go bump or insolvent as well. So just want to think about really. Next we have, just to break down what the difference. So the first two on here, we've got equities and bonds, just to break down what the difference are, because they're the main two that make up most portfolios. So portfolio being what you're invested in overall, so your portfolio of assets that you might have. So a share is a percentage of a company that you own, and it pays dividends from the profit of the company. So if you invested in, let's just say, Apple or Amazon as a share, you said I wanted to buy X amount of shares of that company, you then have it written up. You essentially then own part of that company as a share. Now, there's different share schemes that you can have in companies, and if one company is floated on the stock market, that'll be different than if it's one of a limited company. However, just for simplicity, a share is a percentage of a company that you own. And then because of that, you've essentially, by buying into it, you're then eligible for a dividend that is that would be paid out if any profits are due they could pay that dividends out. Not guaranteed that they would. Some companies have been paying dividends for years and years and have been consistently doing so, and some pretty much don't pay any at all because they're reinvesting profits to grow that company, and in which case you're then benefiting from the potential growth of that share. So whereas a physical property, you've got rent and you've got the capital appreciation, so the value of the house is going up, and you've also got the rental income as a guaranteed sort of, not guaranteed, but you've got it as an income source, all being well. A share kind of does the same thing depending on what type of share it is. You've got the appreciation of the share itself, but then also you've got the potential for a dividends to be received. Now, with a bond is essentially a loan to a company or government, as I've mentioned. Now, this is where a big company or organization needs to raise finance so they can issue bonds. Those bonds are then sold and you can purchase those bonds. So you've essentially loaned money to the company and they pay then an interest for doing that. That's a very simple format of how it works. And between these two, between shares and bonds, they're a big part of what goes into creating a portfolio. Shares are more volatile but have a much bigger upside, and bonds are a little bit more stable long term. However, the less likely to see that growth. So you kind of need a combination of both, depending on how you feel about investing long term, and if you can ride out those ups and downs long term, and what kind of effect that might have on your money. So then so if you were to kind of mash all those together and go, well, what is a fund? A fund is literally a collective of shares and bonds. So most people in their pensions or ISA would typically have a fund. You can have directly held shares, and if you know what you're doing and you can build up your own portfolio of individual shares, brilliant. But for most people, a fund is a kind of a way that professionals already pulled them together and kind of wrapped it into a fund. So if you were to peel open the can and look at this particular fund that you might have, inside you would see different shares, different bonds, and then all of those would be pulled together to kind of align to what your attitude to risk is if you were to select that fund, or what you were comfortable with that fund investing in. So it kind of pulls them all together for you, really. So hope that makes sense. Now, sort of when to invest, when's the kind of best time, really? Well, I always say now. If you've got or a saying that I've kind of said quite a lot recently, is the best time to plant a tree is 20 years ago, and the next best time is now. So having money to invest, you don't need lots of it, but having something can have a profound effect long term, because the biggest impact that investing has, or your growth in your money has, is more to do with the time horizon that you invest for, because of the effects of compounded interest, which is essentially where you earn interest on your interest. So if you imagine having £100 and then you add 10% on that, and then you add the £100 plus the 10%, well, next time you've got interest on top of that, because you've got the £100 plus the 10%, and you're getting 10% on all of it. So it's there's kind of I can't remember who explained it, but if you put like a grain of rice on a checkboard, and you were to put, like, every time that you put a grain of rice on each black or white checker, and you were to double it each time, by the time you got to the end of the chessboard and you've doubled it, it's at like astronomical amounts. Like if you just Google it and have a look, you'll see how it completely blows your mind on how compounding essentially works. And it has the biggest profound effect on your investments long term. So the longer you have to invest, great. If you don't have a long time, or you're thinking, I don't have the greatest amount of time, or I need that money sooner, really need to be thinking over about a minimum of a 5-year period anyway, whether it comes to investing, which is what we'll cover off shortly, and I'll kind of explain how to break that down for you as well. So when investing, think with the end in mind. So what is it you want? Touched on this a little bit already, but is it for a holiday? Is it more family time? Is it paying off a mortgage? Is it less stress? Is it capital preservation? There's no right answer. It's just what you're wanting to do with your funds and what you plan to use it for. So should I save to invest a lump sum first, or should I just start investing now, like on a regular amount? Well, kind of depends on your situation. If you're in a situation where you can and you have got a lump sum up front, that does you and you're in a great position to be able to do that. That does have a much bigger impact long term because you're investing a bigger capital, and then over time that can compound. If you haven't, then just starting with some regular amounts, still you're going to benefit from that compounding over time as well. And just as a bit of a kind of expand on that a little bit, you've got a thing called pound cost averaging. So this is where you invest a regular amount each month, whether the stock market's going up, down, staying the same, doesn't matter. You just almost set it and forget it and just go, right, I'm going to invest £100, £50, £200, £600, doesn't matter what the amount is. And you just set that every single month and go, it's going to get paid, almost and see it as a bill, really. And when that, if as the market goes down, you're essentially going to be able to buy more units, and as it goes up, you're just going to keep continuing purchasing. So long term, you just keep purchasing, and you then get to benefit from this pound cost averaging sort of strategy. Really, I'm not going to go into all the nitty gritty of the workings of it, but that's the simple crux of it. And then you've got lump sum investing. If you had one lump sum to invest and you could do it up front, long term, it does have a. I know this graph looks a bit misleading, but it was just one that I've just thrown together really for sort of illustrative purposes. But lump sum investing will have a longer impact because you've got more funds invested for a longer period up front than if you were to slowly build it up. So it does have a bigger, profound effect by lump sum investing. But again, it's really down to your situation. If you've got the money to invest up front, brilliant. And if you haven't, just starting with what you've got available is what's going to move the needle for you, really. And I'll come on how you can kind of quantify what to invest again in a moment when we come on to the how-to part. So what about paying off debt or investing then? So a few things to consider. What is the interest on debt you're paying? If you're paying a higher amount of interest on debt than you believe that you could achieve from investing. So if you've got credit cards and they're 12, 13, 14% or a finance that's quite high, what you need to be thinking about then is going, well, am I going to be able to, from my investment knowledge and what I'm investing in and my attitude to risk and what I'm comfortable with this money, are you going to be able to get a return on that money that's going to be higher than what you're going to be able to save? Because saving on interest is money in your pocket, the same as earning interest is money in your pocket. So saving on interest or actually earning growth on interest are kind of the same thing, really, if you've got debt to pay off. So yes, you need to just make sure that the interest you're going to be saving is going to be higher than you feel like you could generate. And then also the few of the things that come into this is how long is that debt for? So if the debt's for 3 years, it's probably unlikely, unless you're some absolute wizard in investing or you're trying something more adventurous, that you're going to be able to generate a return over that 3 years that would potentially beat what that debt would be. Now, if you're doing it, if the debt's like a mortgage, for instance, which is a good example, as opposed to something like a credit card or a car loan or just a personal loan, if it's something longer term, and interest rates are typically lower on mortgages than they would be for personal loans, just because of the risk element of them, you could then potentially think, well, I'm going to invest for the same time alongside my mortgage and see if I can, instead of overpaying on a mortgage, maybe I could invest, and hopefully that would be able to outpace it as well. So that's something else that you could consider. What's your attitude to risk? If you've got quite a low tolerance to, seeing your funds going up and down, and you feel like that would make you quite nervous, then it might be that paying down on the debt in most cases is going to be more suitable. It's going to be guaranteed interest that you've saved, and it's going to mean that you're going to be in a more comfortable position. But if you're a little bit more comfortable and you've got the ability to be able to invest that, and you're comfortable to see the ups and downs along the way because it's not a short-term solution, then it could be that could outpace the debt as well. So something else to consider, and again, I'll touch on how to sort of help quantify the attitude to risk. There's a few different ways you can do that. I've already mentioned paying down the debt. And the other thing is, could you just restructure things as well? Could you just move? I know it's not sort of debt that we're talking about here on saving things off, but it does all sort of fall under the same umbrella of finance. So, could you restructure some of those loans or credit cards to move them to 0% interest and keep paying them down, and then also invest on top? And then you're kind of doing a bit of both. So it's not a do one or the other. It's kind of a sliding scale, and depending on what your situation is, means that you can move it and sort of tailor it to what's going to be most suitable for you, really. And that's quite a lot of what I do as an advisor as well, is generating that kind of vision of what we're looking to do and put a plan in place for things. So a few things to consider there. So I've already mentioned this. So if you feel you can save more in interest than you can make from investing, then that might be a better option. However, you don't need to pick one side. Can do a combination of both. So how to actually invest then? So a few things we've got is the longer you have, the more you can afford to ride out the bumps in the road when investing. So if you've only got 2-3 years, really that's quite a short time frame to be investing over. So really you need to be thinking 5+ years to actually start generating the returns long term, because you are going to see those bumps like that little kind of picture illustration shows there. You're going to see it going up and down along the way. So you need to make sure that you're not needing the money in a short time frame when there's going to be a potential down. Now, there's no guarantee of knowing when you need the money in 7 years that there's going to be an economic downturn and you're going to need it. However, when you look at and you sort of back test this and look at data from historical, and you look over a period of time, you can see that from where it started. And if you look at the in the FTSE 100, which is the top 100 companies in the UK, from when they first tracked it to where it is now, you can see quite a steep increase over that period of time as well. So the longer you have to invest, the more percentage likeliness that you're going to actually make a reasonable return. So how would you even start by sort of structuring your finances? If you've got a capital, and then I'll come on to if you don't. So first is 3 to 6 months 3 to 6 months cash buffer and sort of liquid investments. So that would be just savings accounts. So that first bucket is very much just your savings account. It's essentially your emergency fund. So having this set aside means that a couple of things. It means it gives you peace of mind. It takes out the anxiety out of not having any savings at all, because they're easily accessible, and it also safeguards your investments. So you don't need to go, well, I'm going to put all my money into an investment, and then the car breaks and you go, well, I'm going to have to sell it. And then you have to sell it at an unreasonable time, or if the market's low, or even if there's transactional costs and it's starting to erode into your actual investment. So it safeguards your investments, but also gives you peace of mind. And it means that you're also preventing the need to use credit cards and debt as well, which if you start accruing debt when you've got investments, you might as well just pretty much start to look to cancel each other out and pay off the debt with the investments and things. So you just need to sort of have a look to see what your situation is, but it kind of acts as a buffer and a backstop. So that's your first pot. Then you've got your 5-year plan spend. So what do you need to spend and plan to even want to spend in 5 years from any amount of capital that you might have? So, is it kitchens, bathrooms that need replacing? Is it just a holiday that you've got planned? Is it a wedding coming up? Is it university fees for yourself or children? Whatever it is. It's just mapping out, right, what's your 5-year plan spend? Because 5 years is really the minimum amount of time that you need to be looking to invest for. So having that set aside means, again, this one is mainly to safeguard the investment. You've already got the emergency fund there. This one's to safeguard the investment over that 5-year period. And this would be in just, again, savings account, or you could even be a bit more fancy and structure these in some set, perhaps like 1 year or 2-year savings, fixed term savers. So you've still got the emergency fund, but this 5-year plan spend bucket that you might have, you could think, well, we don't need that now. We need it in 2 years, because that's when, someone's getting married and I need to access it at that point. So you might just do a 2-year savings account, not to essentially get a real growth on the money, but just to help safeguard against that inflation risk as well. So mapping it out, having a plan really is really going to be sort of key to planning that out. Then you've got your 5-year plus. So anything 5 years and a plus that you don't need, that's your kind of investable amount at that point. And this is where you'll have it in equities, bonds, properties, whatever it might be. You can look to start to actually, get a bit more fancy with that and decide where you might want to put it, how you want to structure it, and what that long-term goal is for. Could be anything from retirement planning, which I've spoken about previously, could be retirement planning, or it could just be for a goal that you're wanting to save for or invest for long term. So then we've got how this actually works. So this example and this sort of little 3 boxes thing is exactly what I do with clients when I sit down and help quantify if they've got savings that they don't know what to do with, or they've had them there for a while, the bank's still paying like low interest rates, and you're thinking I want to get a high return than that, or I've got a goal that I want to sort of aim for, then this is a bit of an example for you. So if you had 70,000 to invest, first thing to do, the very first thing is do a budget planner first. So find out what your income is, find out where your expenditure is, and then also check what's left over. This will help deem just what your goals are and also help quantify what your emergency fund needs to be. Because if you know what your expenses are, it's actually 3 times your expenses of what you need for your emergency fund. So, you could do it where it's just 3 times your income, but to kind of drill it down, essentially, if your expenses were 3,000, 3 times of that is 9,000 is what you would had that you wouldn't invest and just put aside in an easy access account. And if you're a married couple, or even a couple that are living together, a joint account is ideal as well, just because if something happened to one of you, the bank account's not going to get locked. So plan spend for 5 years, as I've already mentioned. New kitchens, new cars, moving house. You then quantify that number. And I always say to clients, if this number happens to erode all of your money for the future for investing, that's okay. Like, we want it to be realistic. We don't want to just try and shove it all into investing if you've got things that you still need to earmark. It's not for me to tell you how to live your life, or anybody for that matter. It's very much there for, right, this is to safeguard the investment. So if a lot of it, and I've sat with clients where a big chunk of it is because they're doing big house moves and they're gifting money to children for purchasing the first home, lots of different situations. And then there's a smaller amount left over to invest. That's okay. There is literally no right or wrong answer. So then what is left is your then futurable investable amount. And then how we look to invest that is different strategies, but that's the kind of first basis of, right, this is the amount we've got to work with. And then I always just ask people, does that feel comfortable? Even though that we've put it out on paper and we might have got nodding heads along the way and we go, yes, yep, that makes sense. That's what we need for that. But does that actually make you feel comfortable? If we were to invest £32,000, are you okay with that as well? Because it is your money, and we just need to make sure that it's suitable for your situation. Again, because we don't want those sleepless nights. So if you don't have a capital amount to actually invest, or an upfront, or haven't inherited any money, or whatever the situation is, what could you do? So first, I would always start with a budget planner first. This is even probably more key at this point. Is first you save up for the emergency fund, and if you know the budget and you know your budget planner, you know what you've got left over. And if there's no budget left over, you need to start having a look at restructuring things. Is there a way in which you can create a little bit of a gap to try and get ahead? As small as it may be, it all does help. And then with that amount, that's going to be first used towards building that emergency fund if you don't have one. So that's the first port of call. The next thing will be once you've got that surplus amount and you've got an emergency, already got an emergency fund build up, is to essentially look at, with that surplus, look at ways that you can utilize that and invest in it long term. So you need to know what your household income is, minus after tax, that is, because you want to know what you've got coming into the household, not what your pay slip says before tax. You need to know physically what you're getting in, minus the expenses that it's going to be costing you. I even factor in yearly expenses to this. So yearly expenses, you could pay for your insurances yearly, you could pay for certain bills yearly. You need to make sure that those are factored in as well. A simple way of doing it is just what they are, divide them by 12, and then add all of those together and just put it into a budget planner as a 12th of whatever that cost is. It's a very simple way. It's not foolproof, but it does give you an idea without getting too complicated. Then once you've got all of those, you know what your surplus is, and then you can start to use that towards investing. Now, it doesn't matter if it could be a very small amount. It could be £25, £50. It could be £100, £1,000, £2,000. It could start very small, and you could build it as your income and your surplus builds up to start snowballing that and building it up over time as well. So now what do you do after that? Well, you choose your preferred platform. So few things so you know what money you're going to use, you know what your spare money is, or you could do a combination of both. What are you actually going to do with it then? So first thing you need to do, like I said, is choose your platform. So you need to make sure that the platform is where your money's being held. It's not what you're investing in, it's just where it's being held. And I've got a kind of an illustration that will help kind of explain this a little bit more in a moment, so you can kind of hopefully wrap your head around and just create a bit of understanding. But the platform could be like Aviva or Fidelity, Intelligent Investor, Hargreaves Lansdown, AJ Bell. There's just a few that I've just thrown up there of probably the ones that people have maybe heard of. You need to check functionality, the interface, the reputation, the service, and the fund choice and the costs. There are a few things that you just need to pick. Where do you want your kind of funds to be kind of initially held in on that platform first? Then you need to just kind of check, really, are you needing advice or guidance, or are you managing the investments yourself? So some platforms are ready-made and others you are going to be completely down to you. So an example of this is whether you have, it's called like a decision tree. So you start at the top and there's a number of questions that go, would you prefer this? Yes. Would you prefer that? No. And it goes all the way down until it gives you a solution that it says this may be suitable for you, and then you can invest off the back of that. It's not advice, but it is a bit of guidance and a bit of a decision tree. Very basic, but can be enough for most people. Then you've got actually speaking with an advisor like myself, and there is different types of advisor. You've got independent advisors, you've got advisors that specialize in just certain areas, you've got restricted advisors, advisors that only work in a bank. So if you went to an advisor that only worked in a major bank, they're only going to offer services from that bank, not completely independent, which I sit under that sort of independent banner. So there's the two different things. That's part of the decision process as well, is do you need the advisor or do you not? Got clients that have come to me and I've said, you seem to know quite a bit about it. Are you comfortable doing it yourself? And in some cases it's, I just wanted to just chat with somebody and see what it was all about. Other times it's, I could have a go at it, but I just don't want to monitor it day to day. And there's a lot that goes on. It could be because you're busy. It could be because you don't want the sleepless nights of looking at it. We've got some clients that just like their yearly review with me, and we sit down and have a chat and go, right, this is what's happened, and they've not monitored it at all. And I've got other clients that monitor it pretty much every other week or so and just sort of check in and see what's going on. So it's completely bespoke to what you want to do. After you've kind of driven down into that a little bit, or dived down into that, and you've gone, right, I know what the investment platform is that I want to go on. I know that whether I need advice or not. And again, some platforms are advised platforms. Some platforms you can use decision trees, some more basic ones where you just pick maybe one of three, where you just go, well, I either want this option, or this option. There's only three on the table. Whereas if you come to an independent advisor, you've got thousands and thousands of options, which they'll help you sort of drill down into. Then you go into the actual investment strategy. So the strategies are, there's two main ones, and then they kind of go a little bit further, but the main ones here are passive investments. So passive investment fund is essentially one that just tracks an index. So it could track something like the FTSE 100, which is the top 100 companies in the UK, and it's electronically sort of programmed that what the actual assets are, so what the companies are and how they're performing, it will just track as closely as it physically can along the way to mirror what the top 100 companies are doing. And then you really just, in that instance with the FTSE 100, you're just kind of hoping that the UK economy is the place to be in that instance. and it just tracks it simply. They are quite low, very low cost compared to other types of investment strategies because there's nobody else that really sits behind it. If you're doing this directly yourself, there's no obviously advisor costs, and there's also no fund management costs because nobody else is monitoring it. It's just an electronic system that does track it, which some people absolutely love. And I've got clients that love it. And I've got other clients that go, well, I don't really like the idea of just robots and just assuming that it's going to do what it needs to do. They like to know that someone's got a hands-on approach with it as well. So again, this is all sort of independent to you as a person. Then you've got active managed, which is where there'll be certain funds or shares that are managed by an investment manager. So they'll make the decisions instead of it just tracking an index. It's essentially where they will buy and sell assets or funds or shares in companies because they feel, oh, this one's performing well, so we're going to keep it. This one's underperforming, we're going to sell it off and change it. And it's where somebody behind the scenes is actually doing the sort of the maneuvering that they need to in the micro to make sure that it's, either staying within your parameters that you've set, your attitude to risk, staying within your parameters, or they're actually trying to get the performance that you're hoping for, depending on what the fund's designed to do, and depends on what the actual fund's made up of as well. But the majority of the time, there's objectives for these, and there's documentation that you can look into that help sort of pick out what the investment or the fund manager's goal is for that particular fund. So other types of strategies, you've got model portfolios, which are kind of a little bit more off the shelf type, a group of funds put together, and those funds are a model portfolio, and they'll typically rebalance. So rebalancing is the method of, as performance on some funds is going to go up and some are not going to, they need to essentially rebalance them to bring them all in line. Otherwise, over time, they will drift and they'll keep drifting. And what we don't want them to do is start to go out of kilter of what you originally wanted. So a model portfolio will just automatically rebalance, and it can be every quarter, it could be every 6 months, depending on what the model portfolio is. Then you've got discretionary fund management, which essentially is where you will have somebody else, not an advisor, but somebody else that's, you kind of see them as an advisor, but they are an investment manager, and they will actually manage that particular fund for you. This is different to a fund manager because they have more discretion on doing things on your behalf. So a fund manager will have set parameters, but as a discretionary investment manager has a little bit wider scope. You have a chat with them. There is more of a person-to-person situation, and they will actually sit down and go, right, this is what we're going to look to do for you. I'm not going to go too much into detail because it's slightly more complex, and you typically need larger values investments to be able to utilize one. It's usually about $250,000. It starts with most discretionary investment managers that they'll start kind of coming into the conversation. Then you've got a model portfolio service, which kind of in between a discretionary fund manager and a model portfolio. It's like a one person looks over lots of funds and they can make decisions collectively over them all to see if they need to buy or sell certain things, again within set parameters. But instead of it just automatically doing it, there's a fund manager, or as part of the model portfolio service, somebody has that discretion to make those tweaks as well. So it kind of sits in between an automatic rebalance of a model portfolio and then someone having complete discretion. It's kind of halfway house, really, is the way to think about it. And the last one is responsible investing, or environmental, social, and governance. So this is just where you might have preferences for certain types of investments. I don't want to invest in oil. I don't want to invest in armament or anything that's going to go towards any war or coal mines. That's kind of negatively not wanting to invest in things. And then you've got positive investing towards, green, sustainable energies, wind farms, solar farms. It depends on what your type of outlook on life is and what you want to achieve. That you can look to select funds that might lean more towards that. And more funds are coming to market that are just automatically doing that as well as part of their investment strategy. They're not even labeling themselves in some cases as responsible investing. It's just the way that the sort of economy is growing and the way that they're structuring things as well. So that's some of the investment strategies. Once you have kind of drilled down your investment strategy and go, what am I going to do now? It's establish your attitude to risk. So your attitude to risk is how comfortable you're willing to take certain risk on your money that you've invested. And again, this is a very emotional kind of outlook to it. And there's a few ways you can determine this. One is, if you speak to an advisor like myself, we'll go through things like the questionnaires and things that I'll essentially ask you and say, out of these sort of pictorials, and I'll ask a question out, or sometimes, a lot of the time, I like to do it completely unbiased. So I like to just give you the question and let you have a read on it, so you've not got any of my kind of biases or anything like that that might come into conversation. You can just have, and it's then completely autonomous. Then once I've got that information, I'll then chat with you and get to know more, and then we kind of come to a nice halfway house. So that's one way. The other way could be essentially just, if you haven't got an advisor to help establish your attitude to risk, it's, to be honest, it's quite tricky to know, because you might think I'm quite risk averse, but then actually you know, you like to buy the lottery tickets, you like to do scratch cards, you like to you know, might like to gamble a little bit or go to the horse races because you're comfortable with that type of way of life, and you think, well, that's comfortable for me to do. So your attitude to risk actually higher than what you initially thought. Or it could be the other way, where you actually do things like the lottery and you think, well, actually, I'm quite risk taker because I do things like this. But actually, when it comes to your savings, you've never invested before, you don't like the idea of investing, you don't like the idea of losing money, just some of it you'll use for certain things. So there is no right or wrong answer. And again, it's quite, you know, independent and for you as a person. But the attitude to risk is very much the way I do it. There's questionnaires and things that I go through to help me determine what that is for you independently, and then just have a human, realistic conversation around, what are you as a person and how do you feel if this was to happen? How would you feel? And if this was to happen going forward, you know, would that give you things like sleepless nights? Would you be awake? You know, I'm there to obviously help if you need to call and talk through things. If you see things on the news, will that have an effect on what you want to do with your investments? All of this play a big part in what your investment strategy is going to be. The other thing to make sure is, even though that might be how you perceive yourself and how your attitude to risk you feel actually is, what's your capacity for loss? So if you've got no savings, and if all of your income is being used on all of your outgoings, and you happen to have just inherited some money, it might be that if that money was to disappear, your capacity for loss is quite low. Or a really good example is, if you're living off a pension fund and you need that pension to sustain you for as long as you can, if that fund value was to drop, it's going to have a big, profound impact on your lifestyle. And then your capacity for loss is very low because you need that money. But if you've got, like, you know, a job, you've got good savings, there's two people in the household, you know, your mortgage is quite low, you've got surplus income, and then you wanted to invest on the side, actually, if that money was to, even if it was to completely disappear, it's obviously not the goal, but if that was to completely just disappear, it's not going to affect your day-to-day living, and that's your capacity for loss. So the two are very different, and making sure that both are aligned to what you're wanting to achieve is part of all the investment planning. So things to consider. So charges, I'm not going to read these, so it's a big slide, so don't worry. But if you want to take a screen capture of it, or just have a read while I'm sort of talking through it, you've got charges with investments that do have a profound effect on the overall outcome of what it is. So even though you might get great returns, if it costs an absolute fortune to have that fund and it's eroding all of the returns, it's not really going to be worthwhile. So you've got initial charges for sort of setting up, and some funds do this, some don't. You've got annual management charges, which are on per annum. What's it going to cost you? And you need to sort of have a think about, right, if you've got an active managed approach, which I said is a fund manager, that's where they'll use this annual management charge to cover their fees, because they're not working for free. They're going to be working to try and get you a high return, and you have to kind of weigh up those benefits. You've got total expense ratio and ongoing charges. Are essentially, they are the same thing. It's just the ongoing charges is the new naming convention of it. But on some older documents, you might see total expense ratio. It's essentially all of the costs as well that sort of come into the ongoing charges and the running costs of that particular fund or investment. It doesn't take into account transactional costs or performance fees and things that could be as part of it, but it gives you a good overall round example of what it could look like long term. factoring in those costs. And this is all a massive part of, again, what I do as an advisor when we're comparing different funds and performances. And if you've got current existing investments, we compare it to what I'm going to be recommending. And does it look like it beats it either on sort of the price, or does it beat it on the performance? And how's that going to look? Obviously, there's always no guarantee, but it does give it does play a big part in the overall evidencing of the research. Then we've got transactional costs. Harder to quantify, but the transactional costs essentially are if a fund manager or certain type of fund need to buy and sell certain assets to actually keep it all in line with what they need. That's quite and there's going to be transactional costs for doing that. They can all erode into essentially your profit. So all of these you need to kind of keep a fine eye on to make sure that it's not a detriment of your growth, because it might be great getting 5, 6, 7% returns, but then if fees are like 6 or 7%, you broke even. So you need to essentially just make sure that you're actually going to be net better off. Then there are exit charges, or there may be exit charges with certain types of funds, particularly ones that I recommend. Never recommend an exit charge anyway, because I just think it's a bit silly. But there is ones out there that do have an exit charge on them, and you just need to make sure that that's not going to wipe out any growth that you've had, and then you go, oh, well, this growth is brilliant, and then sell, and then you've essentially eaten up any of that growth because of the exit penalty, because you've exited over a certain time period, or things like that you need to factor in. Then we've got, this is the kind of analogy that hopefully gives you a bit of an easy thinking point to just very basically understand what it's all about. So the platform, I say to clients, see it as the shop. See it as Sainsbury's or Aldi or M&S, wherever you shop. See the platform as the shop, and the platform could be Aviva or Royal London, or it could be Fidelity, Intelligent Investor, Hargreaves Lansdowne. That's your main shop that you go in through the front door. Then you've got the product. Product being, is it an ISA that you're looking to actually use within that? Is it a pension account? Is it or like a retirement account? Is it just a general investment account? Is it a junior ISA? What's the product, which is essentially like how you hold your investments in the shop. And then you've got the funds, which are the individual assets that you hold. So it could be I'm investing in a certain type of companies here, or I've got a fund that invests in the UK stock market, or I've got funds that are sort of globally diversified. They are like the products or the funds that you are like the tin of beans that you pick off the shelf. Now, as the reason why I use this analogy is because if you go into Aldi, yes, you're still going to have to get the same products, like a retirement account or something like that. Or in this case, I've used a trolley in a basket. You're still going to get the same kind of experience, but the products or the funds, the actual tin of beans, are going to be Aldi's own ones, as opposed to getting Heinz beans as an example. So you just need to make sure that the platform fits to what you're wanting to achieve, because there's no point selecting a platform that you can't do what you need to do because they don't have access to those certain funds, or in some cases they don't even have access to certain products. You go into a smaller kind of corner shop or a local shop, they're not necessarily going to have trolleys, so you're going to need baskets instead. Well, is that going to be fit for your kind of investment strategy? So I hope that kind of gives a bit of an easier example of understanding what the platform, the product, and the fund actually do. So what tools can you use? So we've got things called tax wrappers. So if you imagine these on the left are that trolley or that basket, you've got ISA accounts, and I'll show a slide in a moment that'll show you the different types of ISA account. You've got a VCTs or venture capitalist trusts. I'm not going to talk about these last three that I'm going to just mention in a moment, because they are much more complicated and are typically much higher risk. But if you think about VCTs, EIS, and SEIS or Seed Enterprise Investment Schemes, just think sort of Dragon's Den. You're investing in very small, much smaller startup companies, and a VCT is basically investing in a group of them together. So they're kind of very good from a tax perspective, but they are very complicated and are much higher risk, so only suitable for certain type of people. And then at the very top one that I've actually missed is pensions as well. That's a tax wrapper. So I call them tax wrappers because you don't invest in an ISA. The ISA is the wrapper that holds your funds within. And it just means that because it's wrapped in an ISA, you're benefiting from a tax efficient saving. So with pensions, you get tax-free growth, you get in tax relief on the way in. With you do get tax on the way out, but the two big reliefs there are massive. You get on an ISA, you get tax-free growth and tax relief on the way out. And then VCTs and ISAs are a bit more complicated, so I'm not going to go into those. And then we've got sort of more direct, you've got property. So you can't put a property in an ISA. A property is just invested in directly yourself. If you were to buy like a buy-to-let as an example, so it's exposed to certain types of taxes, much like a general investment account. So a general investment account is if you were to just hold funds or investments directly and weren't to wrap them within an ISA or a pension, you would be then exposed to income tax to consider, and you've got capital gains tax and even stamp duty. And you do actually have stamp duty on certain type of investments as well. It's not just property, it's just that it's stamp duty land tax you pay on properties and the stamp duty that you can actually pay on investments as well. So all of these are considered, which is why you'd always look to do it within a pension or an ISA first. And then if you've got spare money and you've utilised allowances, then you would backfill into other things. Or you just might be using property and that's your preferred investment strategy. That would be something that you couldn't necessarily wrap into a ISA. You can put certain types of property in pensions, and I spoke about it previously, like commercial property in SIPs and things. So there is kind of slight crossovers, but as a rule, residential property or buy-to-lets, it's just a directly held investment. This is the ISA page that I mentioned. You can get it on my website under the investments tab if you need to actually download it. But essentially, it just gives you what the different types of ISA account is. You've got cash, help to buy, which is no longer available, but some people have still got them, sort of legacy plans. You've got lifetime ISAs, but in cash. You've got lifetime ISAs, but you can actually invest in stocks and shares. Innovative finance ISA, a bit more complicated. It's sort of peer-to-peer lending. You've got stocks and shares, investing, what I've already mentioned. When you invest in, most people think of stocks and shares ISAs. Junior ISA and then junior stocks and shares as well. So they're a sort of a wrap up of the different types of ISA account that you can have. And just to give you a bit of a snippet on the different ways in which you can look to invest as a whole. So I'll just go last slide to summarize really is we have the covered off, hopefully, for you to be able to have a bit better of an understanding of why to invest, what are the types of investments and sort of when to start, how to invest, and what tools can be used. So appreciate there is a lot to sort of digest there and to take on board, but ultimately it's kind of giving you as much information as I can in a shorter period as I can, so that you can have enough information to at least ask the right questions. I'm not expecting you to be able to just all of a sudden go and pick a platform and start investing, because there is thousands of funds and loads of different platforms and the kind of world's your oyster really when you start looking at it. But it's to give you enough information to get a grasp on it, so that then you've got enough information to ask the right questions, whether that's just Googling the right questions or even asking me questions, whatever it might be. Hopefully that helps sort of solidify a little bit of knowledge, because, again, as I've said before, you don't really get taught any of this at school. So the least I can do is just share some of that knowledge that I've got in a short space of time as I can, really. So that's the crux of what I needed to cover off with you today. So hopefully it's been useful, and thanks for watching. And hopefully I will catch you in the next one.